Hello, everybody. This is Noah and John, and we are from UrbanDigs. And today we'll be talking Manhattan. And John, we got a good one today. We're going to go in the world of mortgages. We got Melissa Cohn. I have known Melissa for a long, long time. She is regional vice president at William Raveis Mortgage, and she knows everything that there is to know about the mortgage market. This is one of those contacts you got to have in back pocket, okay, just to bring out in case. And Melissa, thank you for joining. I'm going to get right into it. I'm going to ask the first question. The Fed rates, they had a meeting, a decision yesterday. They paused, but there was some type of reaction. Rates are coming down, I think. I want to get your take on what that means for mortgages and for the near future.
So you're right. The good news is the Fed decided not to hike rates, which was a low probability option. And obviously, because of the strong economic data that we've had, they didn't raise rates. But in his press conference, Powell was actually pretty dovish in his remarks. First of all, there's been a lot of concern, a lot of fear of stagflation. And in his own words, he said he didn't see the stag and he didn't see inflation. So that eased investors' minds. And in addition, he indicated that their next move would likely not be a rate hike, and he didn't rule out rate cuts this year. And he also gave us a dovish olive branch, in the sense that the Fed announced that they were going to slow down the pace of their quantitative tightening. And they've been running off $60 billion a month off their balance sheet, and they're reducing that now to $25 billion. And that's a sign that the Fed is, moving towards the dovish time to drop interest rates mode. Now, he also indicated that they needed more evidence that the rate of inflation has begun to moderate again, because inflation hasn't dropped in 2024. In fact, it went up last month. But I think that what Powell did is he said, we know that we haven't gotten to where we're supposed to be, but it looks like we can get there. And the markets reacted favorably. Now we're back to a data-driven market. So tomorrow's a big day because we get the April jobs report from the federal government. And if we get a jobs report that is not more robust than the market is expecting, I think that we can look for lower interest rates in the next weeks to come.
That would be a bit of a relief, I think, for a lot of folks. And I'm wondering if, given some of what the Fed was talking about and given where rates are today, I was wondering if you could talk about the spread between the fixed and the adjustable rates today.
That's a really good question. Historically, you would see a spread of between a 30-year fixed and call it a 7-year adjustable about 0.75%. And that spread today with many banks is probably less than 0.5%, meaning that sometimes it's better just to go with the 30-year fixed rate option as a better insurance policy than the much lower rate of the adjustable rate loan. A lot of it has to do with risk-based pricing. I think banks are also reticent to see people take low rate adjustable rates, knowing that the Fed is going to cut rates and that interest rates will drop probably significantly over the course of the next 2 years, and that people will want to refinance. So they'd rather see people go into a fixed rate loan where they get a little bit more vig now and know that it's going to end up being refinanced and paid off at some point in the near future. But another interesting thing that we need to look at is what's the general spread of mortgage rates in general over the 10-year Treasury. Historically, 30-year fixed rates mortgages in general have been based at about 1.75% above the 10-year Treasury yield. With all of the volatility, inflation, and higher interest rates, the average spread today is over 3%. So that means if the things start to settle down, if people think that the Fed is really going to start to cut rates, mortgage rates could drop by up to a full percentage point without bond yields dropping at all.
That's really interesting. And I was going to ask you, it's like the Fed does not have to cut rates, or they don't have to cut rates that much. Like they can only cut once, for example, or they can cut nothing. Like what happened yesterday. They could keep them exactly where they are. The markets will still be reacting and moving. And the bottom line is they did nothing and rates have come down.
That's correct, because it's all about what they say, not necessarily what they do.
Right. It's such a great example of the future discounting mechanism that is the markets right now. And they're trying to figure out what is he going to do over the next 3 to 6 months. And it just keeps moving. It's interesting to see play out. I want to move over to the next question over here. And we get this asked a lot, especially now that the whole NAR has come down with the settlement with the commissions and the buyers brokers. And I want to ask you to talk a little bit about buyer financing of commissions for buyer brokers and the commission that is owed to them.
No, that's a great question. And the answer is, as far as the banks are concerned, it's business as usual. So if it is ordinary and customary that the seller pay both the buyer's broker's commissions and the seller's commissions, that's not considered a reduction of the purchase price, as it never has been to date. But now with this new settlement, and with buyers having to sign buyer's broker's commission agreements or acknowledgements, you know, people are talking about what happens when a buyer has to pay their broker's commissions. And the answer is there are three things they can do. One, they can actually pay the commissions, but can't be financed. It's not considered to be an addition to the purchase price. The seller can give them a concession, which would be a contribution towards the buyer's broker's commissions. But seller's concessions, or they're also called interested party contributions, are limited. So for example, if you're buying an investment property, the maximum seller's concession is 2% of the purchase price. If you're buying a primary residence or a second home and you're financing less than 75% of the purchase price, you can take up to 9% of the sales price as the seller's concession. And if it's between 75 and 90%, it is 6%, which is more of the norm. But the seller's concession is really just the seller paying the commission, but in using different terminology. And then the last thing that people ask is, well, what happens if we increase the purchase price in order to finance the buyer's broker's commissions? Technically that's frowned upon by the bank because that's padding what the actual purchase price is, but I have seen it done. But the caveat that we have to give to everyone is then that the property is going to have to appraise at the inflated purchase price. And that doesn't always happen. Banks will use the lower of the actual purchase price or the appraised value. So if you try to raise the price and the appraisal comes in low, then that buyer is going to be stuck having to pay those commissions out of their pocket. And it's important, especially if you have someone who's looking for maximum financing and doesn't have a lot of excess liquidity, that it may get to a point where that buyer may not have the cash available to pay that buyer's broker's commission. And then what?
Right.
Super interesting. And listen, while we're in the weeds, we're kind of talking about some of the more nitpicky things. I want to talk about one of the questions that we often get, which is, we talk a lot of it's co-op versus condo and how that all shakes out. And there's been a new renewed focus rather on new devs, especially post-pandemic, right? Never been lived in, brand new, all the amenities. And one of the things we keep hearing is the difference between warranted and unwarranted, especially when it comes to mortgage. And I wonder if you could talk about that for a little bit.
So in order for a bank to sell a loan to Fannie or Freddie, a condominium or a co-op have to be what's called warrantable. What does warrantable mean? Warrantable means that the building has to meet the standard Fannie Freddie guidelines, and they're not really making exceptions at this point, meaning that a building has to be 51% sold or under contract to owner occupants, that the building has to have 10% of its annual budget in reserves, or there has to be a line item in the budget to replenish the reserves. It used to be that you could have a reserve study, and if the reserve study said that there were no repairs necessary, that you could get an exception on the 10%. That's not the case all the time anymore. And also we have to deal with assessments. And this is not so much a new dev, but in existing condominiums where Fannie and Freddie have come out and said that if there are assessments for deferred maintenance, so for work that needs to be done that the building has been delinquent in doing, that's an automatic failure and an automatic declination of the building. So, what do banks consider? Well, Fannie and Freddie look at all the local law 11 work that has to get done on the facades. That is in some ways considered to be technically a deferred maintenance. And there are plenty of assessments all over the city for those, and that's making it more difficult to get financing. The good news is that if a building has an assessment for regular maintenance and repairs, they're fixing up the lobby, new painting and carpeting in the hallways, improving an amenity, that's not a problem. But there are a lot of buildings that everyone, we've relied upon and we've done financing in time and time again over the years that all of a sudden no longer may not be a warrantable building. And then what happens? Well, the good news is that in New York, we have a lot of regional portfolio lenders who are willing to be more aggressive in terms of their guidelines with regards to financing in a non-warrantable building. And it doesn't necessarily mean that they're going to have to pay a higher rate. I tell people, if you have questions or concerns about a building, the big banks are probably not the place to go, because those, I won't name names, but the bigger big box banks, generally have to follow guidelines, and it's hard in a huge bank to get an exception on the building. Some of our regional savings and loans or credit unions, have more flexibility because they are portfolio lenders, meaning that they are not selling their loans to Fannie and Freddie. They don't always require that the buildings meet Fannie Freddie guidelines, and they make their own decisions. There are some banks that say we look at the quality of the borrower as opposed to the building, because we know it's the borrower who's going to be making the monthly payment and not the building.
Let me ask, with all the talk going on about local law 97, is that impacting the warrantable versus non-warrantable discussion in terms of from the lender's point of view?
It's purely an assessment issue.
Okay.
And a budget issue. And then making sure, does the building have enough money in its budget, in its cash reserves, in order to make the repairs?
Gotcha. And I have a question. The rate is not much higher between, if you have to go outside the normal and go to the regionals, and
not at all. A regular portfolio lender will have rates that'll be comparable, sometimes even better than the big banks will offer.
Okay.
What you will find with many of them is they tend to offer more adjustable rate versus fixed rate options, but that's not such a bad deal right now, because we know that interest rates are going to be coming down. So if you take a 5 or a 7 year adjustable, it's fixed rate for the first 5 or the first 7 years.
Gotcha. Really interesting. We don't talk about this stuff enough. All right, I got another question here, and I want to talk about challenges that you've been seeing or experiencing recently in the lending process from an underwriting perspective, so that the agents and hopefully ultimately the clients that they're talking to could maybe get ahead of any potential landmines that you're seeing happening out there today.
Well, I mean, the first one is going to be income. We're still seeing some of the fallout from people who, because of the pandemic, either changed jobs, changed careers, have been self-employed or haven't been in a job where they received a bonus for a full 2 years, where it was easier to get exceptions, where I had a history of making this, but I changed jobs and I don't have a guarantee anymore. Getting exceptions today has become harder and harder across the board. And income is always an issue, especially if someone has gone from being W-2 to 1099. Like, for example, some of the big commercial real estate companies in New York took all of their W-2 employees and turned them into 1099 employees because it was a tax benefit to that company. It hasn't changed that person's job, it hasn't changed their income, but they're no longer W-2, they become 1099. Technically, if you become 1099, you have to have 2 years of 1099 income or 2 years of tax returns before a bank will consider that income for income verification. The good news with that is that we have what we call these non-QM lenders, who are lenders that will think outside of the box in terms of income verification, where you could, for example, present a 1099 and use that for income verification, produce a profit and loss statement, produce monthly bank statements. Now, those rates are a bit higher, but once again, I tell people it's really about getting you into that new property today, and that we know that rates are going to come down. We know that you'll have more tenure in your career, that you'll have another tax return, and that you'll be able to refinance in a year or two. It's about sort of looking at what you do today as the bridge option. Another issue we come up against oftentimes is in terms of assets. A lot of people have money invested in crypto, and banks will not accept crypto for down payments until after it's been liquidated. And no one wants to liquidate their crypto. And especially with some of the bigger loans, Banks have pretty strong post-closing reserve requirements. And if people think that they're going to be including the crypto in that number, unfortunately, they're mistaken, and they're going to have to liquidate the crypto in order to get it done.
That's
And they're
interesting.
also
That's interesting, because I wouldn't have considered that. Is it simply because of the volatility of crypto has been is it a volatility issue, or is it sort of like a broader accountancy acceptance issue, or are they hand in hand?
I think it's more about a verification issue.
Okay.
When you have crypto, you keep your money in a wallet. You don't get monthly bank statements that have a beginning balance and an ending balance. You tend to get a running transcript of what your balances are. It's hard to see where deposits come in from on the wallet statements. It's hard to see where they're going out. So they're very hard to verify. If crypto had more traditional monthly statements, I bet we could get lenders to consider it. But there's the same volatility in the stock market. I mean, look, we've seen stock markets go up and down 400 or 500 points in a day. So I don't think that the volatility of crypto is any different than the volatility is in the equities markets. It's just a question of being able to verify it in a manner that is acceptable to traditional lenders.
Gotcha.
Really, really interesting stuff here. Melissa, I just thought of a question. Even though I think the answer is no. Are there any mortgage reassignments happening, or is that just hard coded into the language that the mortgage company will not allow a mortgage reassignment?
Do you mean an assumption of a loan?
I'm talking about like a seller has a 3.5% mortgage, 30-year mortgage, and they got 21 years left on the mortgage, and they're going to assign that loan to the new person or something like that. Yeah, assumption.
The answer is that there are assumable loans in this country, but there are only two types. And there's that would be a VA loan or an FHA loan. I can probably count on one hand how many FHA loans there are in New York City, because getting a condominium building approved for FHA is very difficult. Also, FHA loans are only conforming loan amounts. So the answer is there are, but for a regular person who has a regular mortgage, their loans are not assumable. We used to have assumable loans decades ago, but once banks started selling loans onto the secondary market, and once mortgage banking and mortgage-backed securities became such a big industry, banks stopped doing them.
You talk about the 80s, traditional bank lending.
Correct.
Melissa, I just have to ask, when you wake up and you want to get a sense for what's happening out there, what resources do you use on a daily basis to kind of keep yourself up to speed on what's happening in the markets and what's happening in the real estate world?
I look at the bond market and I look at the future stock markets in the morning before when I get up, which is usually like around 6:30. I see what's going on in Europe. I see if there, any news in, what's going on in the Middle East with war, what's going on in Ukraine. Basically you look to see we live in a global economy. So you want to know what's going on around the world, so that we get a sense of before we start getting our data here. And then at 8:30 every morning, when most of the data points get released, I'm like right in front of my screen, wanting to see, because you look at the initial reaction. But I'm very much of a data watcher.
Yeah, we got similar blood.
I mean, it's not very interesting. I don't talk to anyone until I know what's going on in the markets in the morning.
Yeah, I feel naked if I don't check what's going on with the futures market or with yields or credit spreads. I feel a little naked out there. This was awesome. This was awesome. Thank you so much, Melissa Cohn, Regional Vice President over at William Raveis Mortgage. Connect with her. Maybe you have questions. Maybe you'll have some business. Who knows? But I mean, thank you for sharing all your wisdom today and everything that you're seeing and your view. You didn't have to do this, and I appreciate that you did it. John, anything from Melissa, or that's it?
No, I just want to say a heartfelt thank you. I mean, this is fantastic.
My pleasure.
I hope we can have you on Monday Macro one of these days too, because this is just, it really is just, I love it. I love it. It's like
anytime. I'd love to.
Spotlight of wisdom.
I love to talk.
We'll bring you on at some point. All right, Melissa, have a great day. Thank you so much. That is John Walkup. I am Noah Rosenblatt. This has been Talking Manhattan, and we will catch you guys next time.